over the last several months, we've been saying what his basis was for the short squeeze or the silver squeeze you can buy into, meaning it was a slow motion squeeze that no one was acting on. Squeezes, historically, a true squeeze, you don't know about it. It just happens. Well, people know about it are people getting squeezed.
Listen, I'll say this again. To get much above $5,000 in the next 12 to 24 months, even though we're already approaching 4, things, if we think are bad now, are going to have to be a lot worse. Now, part of this also is we've seen just tremendous physical purchasing out of the Far East, particularly in China.
VinceLanci has long emphasized that the gold and silver markets are quietly undergoing one of the most significant structural shifts in modern history. He notes that behind the daily price fluctuations lies a deeper battle between physical demand and paper suppression. According to his analysis, central banks and sovereign wealth funds have been steadily accumulating physical gold, not as a speculative asset, but as an insurance policy against fiat instability. Meanwhile, silver's role is evolving as both a monetary metal and an industrial necessity, creating a dual demand that paper markets can no longer fully control. Lanci argues that this divergence between physical and paper pricing will ultimately force a repricing event, one that could catch mainstream investors completely off guard. In his view, the global monetary landscape is shifting toward tangible collateral. Nations are accumulating gold as a form of settlement outside the Western financial system, and silver is quietly following suit through industrial channels and state-backed supply chains. Lanci believes that when confidence in debt-backed assets falters, precious metals will reprice rapidly to reflect true scarcity and trust value. He often points to the accelerating drawdown of physical inventories on exchanges like the COMEX and LBMA as evidence that a deeper liquidity crisis is brewing in precious metals. For investors, Lanci's message is clear. This is not the time to trade short-term volatility, but to focus on ownership and custody. As global debt spirals and confidence in paper markets erodes, the physical possession of gold and silver becomes not just a hedge, but a form of financial sovereignty. He foresees an eventual moment when supply tightness will overwhelm derivatives, forcing the market to revalue both metals dramatically higher, a move he describes as inevitable, not speculative. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
In the second story, gold nears 4,000 as political turmoil and dollar strain fuel debasement trade. That debasement trade concept is coming from the mainstream media now, which is very interesting. We're not sure if they're doing it because they don't like Trump and they want it to be bad for the dollar, or if they know that we have to debase the dollar. It's hard to say. Gold and silver steadied Tuesday after a volatile rally pushed bullion to within sight of $4,000 an ounce, and silver above $48, really close to 49, as political turbulence from Washington to Paris and Tokyo drove investors toward hard assets. The dollar gained for a second day while Treasury yields crept higher, eating gold's record-setting surge for now. But that continues into post. Gold nears 4,000 as political turmoil and dollar strain fueled debasement trade. Next, Goldman re-raises targets over 10% to 4,900. Now, we recorded something and sent it out to the founders this morning with some technical difficulty. You can read there at 6 a.m. Some thoughts on where we are in the cycle and how this is very strange in a bullish way. Find attached the latest on gold and implicitly silver this time from our friendly neighborhood bullion bank. You can see the name of the bullion bank right there. Hat tip to Zero Hedge. Essentially, give it to you in one sentence. Goldman is raising their target because, and they're not saying it this way, I am, because they're surprised at how sticky the ETF buying has been, pleasantly surprised. And because the floor has been raised, the resilience of the ETF buying, or the response to the mainstream media and their own reports saying to buy gold, has been so well received that they're now raising the roof. Now, that went out to founders this morning. We will break it down and send it out by the PM Gold Fix today for premium. Other stories. Now, we want to go through a couple other stories that we put up. We weren't very active. We were on holiday. Gali warns end may be near in silver for the silver squeeze. If you're a Goldfix subscriber, you probably know that over the last several months, we've been saying what his basis was for the short squeeze or the silver squeeze you can buy into, meaning it was a slow motion squeeze that no one was acting on. Squeezes, historically, a true squeeze, you don't know about it. It just happens. What people know about it are people getting squeezed. So a slow motion squeeze you can buy into is what Gali was describing very accurately. Now, about 4 or 5 days ago, we had received information and insights that perhaps China, India, or even the COMEX will be getting ready to lease metal to the LBMA to at least stem their decline of metal that they need. They need metal to refill, to add to ETFs because that's their job, so to speak. Now, during that time, we said, be careful when China comes back from holiday. It's possible, we weren't assigning a probability to it. It's possible that the arbitrage may flip enough so that China would lease metal to the LBMA or India or the COMEX. Meaning, if you can lease the metal and make a return on your metal and get it back in 30 days, and at the same time do well by the global community, then you're a hero. And that goes to making points with the West if you're China. We think something like that may happen. We're not sure when, we're not predicting, but Dan seems to think that it's nigh. It's about to happen. I'm not sure. We'll see. Special gold, silver, and Japan morning markets. That's a story we put out from the road, a recording. We went through why gold and silver rallied and what Japan had to do with it. Japan's debasement, Japan's prime minister changing, et cetera, et cetera. Michael Howell on Debt Gold and the Coming Monetization, extremely popular Capital Wars author, goes through, we think is very interesting. There's not much time to read interesting in-depth articles right now, but the synopsis of this one for us was interesting because he says that we are monetizing the debt now. So while people like me are saying the debt monetization will come, he's saying don't look at the Fed, look at how the Treasury is financing itself, and that in and of itself is debt monetization. He calls for higher targets in gold, very high targets, but down the line in terms of years. So he's being responsible with his predictions. But his analysis of liquidity, which is really the parent of flows, I look at flows all the time, is pretty convincing. And there's a video there, and we broke it down for everyone. We took the video and we took all the gold out. We took all the monetization part out, and that's for everyone. That's free. And founders, can we innovate inflation away? Let's see what happens on a down day, guys, right? Data on deck. I'm not sure what the focus should be this week, but it's probably going to be anything people can get their hands on. With the lack of data coming out, as you can see there, you're going to see flows dictate more than anything without deadlines. There won't be deadlines. So you may see more continuous volatility without less jerky moves. So I think the highlights would be Wednesday's FOMC minutes. That'll be extremely scrutinized because there's a lack of current data, and consumer sentiment might get a little bit more importance than it has recently. And of course, on Thursday, Jerome Powell talks at 8:30. And again, if there's no data, Wall Street's got to focus on something. And so that's what they're going to do. Ignore that margin raises phrase there. Capitulation or pushback, Besant is in charge and Powell is his pal. That's a note that we wrote to ourselves. We believe that there's a lot more going on that ties in with the increased friendliness of banks to precious metals, the blessing they seem to be getting from the administration, Donald Trump decorating his office in gold more than you would think he would do, and Bitcoin starting to catch a bid now. So we think this is all tied together. So the data we're not so sure about, but October 29th is the Fed decision rate, and Trump and Xi meet. So there's probably going to be aware that there could be a cooling of the geopolitics October 31st. So we may have a dip after October 31st before we go into buy season, if there is even any reason to care about seasonality this year. All right, moving on.
PeterGrandich, on the other hand, envisions gold entering a powerful revaluation phase that could drive its price toward $4,000 per ounce within the next major upcycle. He attributes this forecast to the unprecedented convergence of fiscal irresponsibility, geopolitical risk, and monetary debasement. According to Grandich, the global economy is now trapped in a cycle where every crisis demands larger bailouts and deeper debt issuance, a pattern that guarantees long-term inflation and declining faith in paper assets. Gold, in his analysis, will respond not just as an inflation hedge, but as a reflection of lost confidence in global leadership and financial institutions. Grandich stresses that this time, the rally in gold will be broad-based and sustained by central bank accumulation and retail participation alike. He points out that countries like China, India, and Russia are building massive gold reserves, signaling a gradual but deliberate move away from US dollar dependency. As trust in fiat currencies fades, gold's intrinsic stability and universal acceptance will re-emerge as the cornerstone of value storage and trade settlement. In this environment, Grandich predicts, even conservative institutional investors will be forced to diversify into gold to preserve purchasing power. The old paradigm of low interest rates and infinite liquidity is fading, replaced by a world of debt saturation and declining trust. Grandich's message is not one of fear, but of preparation. The revaluation of gold is not a speculative dream, it's the market's natural response to years of distortion. Let's get back to the interview.
We've done that without, certainly here in the U.S., I can only speak to Elijah, and that we've not done that with typical investor participation. Still, I have a separate planning group, and still to this day, we see 5 to 15 new prospects a week, and not 2% of them have 1% gold in it. So it's not like this has become, well, the reason it's going up is because so many people are getting involved in it, like you see in technology or stocks. You could then beg the question is, what if they do start getting involved in it? What's the number? And that's what you're going to have to believe in for much higher prices over time. But for now, it's still a great accomplishment and a good thing. And there's 2 separate holders of gold right now. And I've been both, and I have both. Listen, if you own gold because you're concerned of a whole bunch of social, economical, and political, don't even think about selling it. Be glad that you bought it a lot lower because you got insurance for a lot cheaper price. If you don't own any and you're concerned about the social, political, and economic, what's stopping you from owning it? But if you bought it between $1,300 and $2,000 because, hey, I just thought I could make money in it, when you got doublings, you got to start thinking about taking something off the table. So no 2 people are alike. I'm not a big believer, although I finally did put out these so-called model portfolios. I never liked them because no 2 people are alike. Many times spouses aren't even alike. But I do think overall, those of us like yourself and your company who've been adamant about ownership of gold. Listen, I put out some numbers today. Just since 2021, the end of 2021, when I said get in gold is up 4 times what the Dow has done. And it's up 4 times since the millennium began. Now, what I beg the question is, to the 99% of people that don't own gold, ask your financial advisor, how come we don't own the #1 investment for the last 25 years? That's the question that I think goes unanswered, that should be answered. Listen, I'll say this again. To get much above $5,000 in the next 12 to 24 months, even though we're already approaching 4, things, if we think are bad now, are going to have to be a lot worse. Now, part of this also is we've seen just tremendous physical purchasing out of the Far East, particularly in China. The difference between us Americans and our Chinese counterparts, they spend weekends in the mall taking hard-earned dollars that they made and buying physical gold for ownership. Here in the U.S., where 2/3 of the people are working paycheck to paycheck, they're borrowing money to go buy things a lot of them don't need that they can't afford to pay for on weekends at the mall. Now, I think the Chinese are going to come out a lot better off than those folks. And so there's changes afoot. I also think, and I go back to an old standby, I think, since you and I started talking, and all this talk early in the year, the death of the BRICS, and Trump is going to break their kneecaps and they're never going to stand. Here's a little secret. Ask people, how many trade deals have actually been done? How many are done, signed, and enacted the way Trump said? You don't even need one hand to count them. That's another reason why gold is being bought, because people outside the United States recognize that the de-dollarization is real, the less concerns about wanting to be involved in the U.S. and its money is occurring, and there's groups outside, especially in the Far East, that are willing to look at trading among themselves without the U.S. participation and in an alternative to paper currencies, particularly the dollar. And look at all, we had the 2 greatest bull markets ever in stocks and bonds, and most people still can't retire. So that traditional stuff, but 20%, now I'd be glad with 2% going in. We can't imagine what the price would be if suddenly people looked at it that way. Let's not forget that right now, it's still kryptonite to most financial advisors, and what they have people in is still getting people's attentions. The technology, the cryptocurrencies and all. Can you imagine if those things just stop going up? Forget about going down. Just stop going up. So the people who want to believe in much higher gold prices, that's going to come from money moving out of financial assets for real. And can that happen? Yes. I will say this much. I think once we get the prints of 4,000 gold and $50 silver, and I don't mean 2 seconds after, maybe days or a few weeks, that's probably going to be a period where we're going to get a pause or some corrective action because the markets are very, very overbought, particularly in gold itself. But for somebody that's looking into 2026 and all, and I'm going to go back and I'm singing to the choir, it's your business, it's not mine. We don't have any, I don't get anything from sales or anything. But I will tell you this, you need to have gold and silver as an insurance policy. It's been that way for years. You had a chance to buy it cheap. It's not cheap anymore. But given everything that's happening in the world, and as I still see these portfolios that come into our office that are 100% financial assets.
Looking ahead, the future trajectory of gold and silver appears to be entering a historic inflection point, one defined not by speculation, but by necessity. The global financial system, long sustained by cheap credit and faith in fiat currencies, is rapidly losing its structural integrity. As debt burdens swell and geopolitical instability intensifies, confidence is shifting back toward tangible stores of value. In such an environment, gold is poised to reclaim its traditional role as the monetary anchor of a fractured global economy, while silver, often underestimated, could emerge as the outperformer of this cycle. With its dual nature as both a monetary and industrial asset, silver's supply-demand imbalance is setting the stage for explosive price action once the paper markets lose control. What's forming is a paradigm where both metals become central to the next phase of financial realignment. Central banks will continue expanding their gold holdings to back new trade and settlement systems, while industrial innovation, particularly in energy, technology, and defense, will tighten silver's availability. As confidence in the dollar wanes, these metals will not only act as hedges, but as instruments of global transition. Price discovery, long manipulated through derivatives and synthetic trades, will eventually reset to reflect real-world scarcity. When that moment arrives, the revaluation could be swift and dramatic, redefining the wealth hierarchy almost overnight. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video.